everyone, and welcome to today's Trust Ed and University session, an insider's guide to managing trust-owned life insurance. Happy Wednesday to all, and we definitely appreciate you taking the time to join us today. Now, for introductions here, my name is Aaron Hansen. I'm the Director of Remediation with ITM, and please welcome Andrea Shemakos, Managing Director with Pendleton Square Trust Company, as our guest speaker for this session. Now, as we get started, we're going to go through and just touch on a few housekeeping items. There will be a post-event survey. I do appreciate you taking the time to complete that, so much thanks there. For today's session, it's going to be approximately 50 to 55 minutes, and we'll do our best to leave time at the end for any questions that you may have. So please do submit any questions through the portal there, if you see that. If we run out of time or we don't get to your question, either Andrea or myself will follow up directly with you after this session wraps up, just to make sure that we touch base and answer any questions you have. And today's webinar is being recorded. You will receive a link within 24 hours that will include instructions for that certificate of completion, if you're going through with that. Now, for today's agenda, we're really going to be covering these following topics that you see on the screen there. Trustee duties and responsibilities. We'll get into the challenges facing ILIT trustees and how to best manage that TOLI risk. When I go between ILIT or TOLI, Irrevocable Life Insurance Trust, or Trust-Owned Life Insurance, acronyms that are commonly used there. For the third section, we get into the practical solutions for dealing with the TOLI policy issues that we see. And then lastly, just considerations with the trustee selections, followed by a brief Q&A. But two things that we definitely want to accomplish today. First, just want you to learn, this information is power. The type of information you will be getting here is real world, things that we do in our day-to-day. And our hope is to really give you the information to understand that the management of life insurance and TOLI risk, understand it better, and to see those situations with a more clear understanding. And then second, just want to get across that life insurance is manageable when we get into this, provided there's processes in place and proper resources and staff. So, if not, you'll see that there can be issues, and maybe even issues that you're not aware of yet. But by the end of today's session, fully expect everybody is going to be experts on the matter. So now to get things started here, we're going to start off with our first topic. I'm going to hand this over to Andrea, and so we'll let you take it away there.
Thanks, Aaron, and I appreciate the opportunity to participate in this webinar with you and to speak to this audience. And as you said, the outset, happy to answer any questions throughout the program. I think somebody already pre-submitted a question, and so I will address it, I promise. Shandy, if you can go to the next slide, I'd appreciate it. So as we talk about ILITs and TOLI, so as Aaron said, ILITs are irrevocable life insurance trusts, TOLI being trust-owned life insurance. As a former practicing estate planning attorney who drafted probably a countless number of trusts, including irrevocable trusts and ILITs, one of the first things that I had to cover with my clients when I was going to draft an ILIT, one of the most important and critical decisions is who to name as trustee. And typically when I raised that question with my clients, the first question back I got was, well, what does the trustee have to do? What are they responsible for? So we're going to talk first about trustee duties and responsibilities. And I will also admit that during my time as a practicing attorney for over 20 years, which is embarrassing to say, but and then I transitioned from a practicing estate planning attorney into the fiduciary world. So in my role at Pendleton Square, I'm a trust administrative officer. I was previously a chief fiduciary officer. And I can honestly say that until I became a fiduciary, fully transitioned from the attorney side to the fiduciary side, I did not appreciate what it took to execute on the duties and responsibilities until I actually wore that trustee hat. You know, as a practicing attorney, I understood the concepts. I obviously knew what all the duties and responsibilities and obligations of a trustee were. I would advise clients about it and I would represent fiduciaries, but I didn't know practically what all of that meant until I actually became a fiduciary. And that's really the crux of what I want to get across during my sections of this presentation, is to communicate to all of the advisors out there, whether you're a life insurance advisor, whether you're a financial advisor, CFP, or an attorney who drafts ILITs, is to bring to bear the practical implications of being a trustee so that collectively as a group of advisors, we can provide much better and transparent counsel to our clients about what it means to be a trustee so they can make the best decision on who to appoint as a trustee. So with that, I will also say that having a conversation about the 16 plus fiduciary duties, responsibilities, and obligations is far beyond the scope of this presentation. So I'm not going to do that. I'm going to instead focus on a handful, maybe 3 or 4 of the key critical fiduciary duties, responsibilities, and obligations that specifically apply in the context of ILIT so that everyone can get a much better flavor of those as it pertains to ILITs, which is the topic of our presentation today. So really the pinnacle fiduciary duty and obligation of a trustee in the administration of a trust is to act in the best interests of and for the benefit of the trust beneficiaries. And in doing that, some of the critical obligations here that pertain to ILITs and TOLI are the management and investment of the assets of the trust, here being a life insurance policy, for the benefit of the trust beneficiaries. And that also implicates what I refer to as the duty of loyalty or the duty of impartiality, probably a little bit more so the duty of loyalty, which is to make sure that all decisions made by the trustee as it pertains to execution of all of their obligations and responsibilities, including management investment of the asset, are solely for the benefit of the trust beneficiaries and not for anyone else. The other is really transparent, open communication with beneficiaries to make sure they understand the trust terms, their rights in the trust, and their rights and interests in the assets of the trust. And there's a lot of different ways that that can be accomplished, including providing written communication and correspondence regarding their rights and interests in the trust, and also the status of the assets of the trust. And so we'll get into some more detail there, but at a high level, those are some of the critical duties and responsibilities I'm going to talk about. And so one of the other things to think about whenever you're talking about TOLI, trust-owned life insurance, is that not only are the duties and responsibilities of a trustee complex, you couple that with what Aaron's going to talk about, life insurance as an asset of the trust. Life insurance is an incredibly complex asset and investment. So you have complexity in the execution of fiduciary duties, and then you have a complex asset to manage. That only amplifies the significance of a trustee's duties and responsibilities. So Shandy, if you can flip to the next slide, I would appreciate it. So let's talk about this a little bit more depth, some of these responsibilities. The first one is investment responsibility. So a trustee, except in circumstances when the investment responsibility is vested with a person other than the trustee. And we'll talk a little bit about that in a couple slides. But generally speaking, a trustee is responsible for the and managing the investments and making investment decisions for the assets of a trust. And when you have a trust that owns what we refer to as concentrated or single asset position, that is a non-diversified asset composition of the trust. So for ILITs that own only a life insurance policy, you have a concentrated investment in a single asset. And generally speaking, trust law in virtually every state that has adopted what's referred to as the Uniform Prudent Investor Act, that state law imposes a duty of diversification on trustees to make sure that the assets of the trust are properly balanced to protect the interests of the beneficiaries. So when you have a single asset position, that can become problematic from a trustee's perspective. And there are a couple of exceptions to that general rule. One is the trust agreement might waive that duty of diversification, provide specific relief and indemnification for a trustee if they hold a concentrated position or a single asset like a life insurance policy. There's also the potential that Section 3 of the UPIA, the Uniform Prudent Investor Act, may apply. And that provision of the UPIA states that if an asset of the trust has a special relationship to the trust and its purpose, then the duty of diversification is waived. And so there, it's whether or not the trust agreement specifically articulates what its purpose is relative to that single asset. So from there, the other considerations from an investment perspective and the life insurance policy is evaluating the policy performance, including making investment decisions on a policy such as a universal life, indexed, variable policy that might have underlying investment decisions to make. And the question is whether or not the trustee has the requisite expertise to make those. To consider those investment decisions as it relates to policy illustrations and projected policy performance. And I know, I'm sure Aaron's going to touch on some of those. So what we're looking at is the policy performing relative to its illustrations to maintain its in-force status, considering the level of premiums made on the policy. So those are the considerations from the investment decision. The other thing I would tell you is that a life insurance policy is, some people may think of it, probably not the way to think of it, but some people may think of it as a set it and forget it type of investment. As long as premiums are made, that's all I have to do as the trustee, make sure the premiums are paid, or any policy owner, make sure the premiums are paid. And generally speaking, for universal variable index policies, that's not the case. Because there is, the policy is dependent on the underlying performance to maintain its investment status. So trustees should, are strongly encouraged to, and I know professional corporate trustees do, is receive an annual policy evaluation to ensure that the policy is performing relative to illustrations and there is not a risk of lapse or a risk that there would be a need to significantly increase premium payments to keep the policy in force. So those are the things from the investment perspective that a trustee should consider and has responsibility and obligations to do. And so if those in and of themselves are not enough, let's talk about a few other obligations on trustees. So the other is the duty to report and inform. And here I'm going to talk about a couple of things. The first one actually touches on a question that was pre-submitted, so I'll get into that. So most all ILITs contain a provision that gives the trust beneficiaries the right to withdraw contributions made to the trust each year so that those contributions and gifts to the trust qualify for the gift tax annual exclusion. And those withdrawal rights are commonly referred to as crummy withdrawal rights. After the case, the famous case, I think it was back from the 50s or 60s, that said that if the beneficiary of a trust has the right to withdraw a contribution made to the trust, it qualifies for the annual gift tax exclusion. because in order to qualify for the annual gift tax exclusion, the gift has to constitute a present interest in property. And generally, a gift to an irrevocable trust is not considered a present interest in property. So a trustee has to account for contributions or gifts made to the trust to determine first whether or not that gift or contribution gives rise to a withdrawal right. It may or it may not, depending on how the trust is drafted, the amount of the contribution, when it occurs during the calendar year, and other factors. The next thing is, to the extent that it does trigger withdrawal right, it's calculating how much each beneficiary's withdrawal right is and then giving them notice of that pursuant to the terms of the trust. Typically, trusts say the trustee has to give notice within 30 days of the gift and give a beneficiary 30 days to withdraw that amount if they choose to do so. So one of the questions that we received in advance was whether or not, whether not giving a crummy notice or not being able to document that notice of the withdrawal right was given has any consequences. And that's a great question. And unfortunately, I don't have a simple answer for that because it's effectively case law driven, because the consequences of either not giving the notice or not being able to document it is the IRS then disallowing the gifts made to the trust to qualify for the annual gift tax exclusion. And the consequence then is using the donor's lifetime exemption. I was at a conference very recently in which someone asked the question of whether or not anyone had had experience with the IRS actually asking for documentation. And we fully anticipated when we asked that question that we would not get any responses, but we actually did. So that's one thing to note, is that while it's not common, it is not unheard of for the IRS to actually ask for documentation about giving crummy withdrawal rights and crummy notices. The other thing, though, is whether or not if you are not able to substantiate it, could you get the benefit anyway? And there are some cases, and I did not get this question enough in advance to look those cases up, but there are some cases that say if a beneficiary has actual or has constructive notice as opposed to actual notice. So crummy notice would constitute actual notice. Constructive notice would be, hey, I know that this happened and I have this withdrawal right because I've been provided with the information that I had this annual withdrawal right. I received a statement that showed that there had been a gift to the trust, or maybe I'm a beneficiary of the trust. And so I obviously knew I had that withdrawal right. I don't have to document it for myself, or other circumstances. The IRS has said if you have constructive notice as a beneficiary, that's sufficient. So that's generally what I would indicate with regard to the answer to that question. So in addition to this crummy withdrawal right, there's also another issue which is very complex and in-depth, and I have a white paper that I published. It's on my LinkedIn page, so take a look at it. But it relates to what's referred to as hanging withdrawal rights, and those are pretty complex tax issue, but that is another thing related to withdrawal rights that trustees need to be aware of and be able to document and track. And then the last part here is also providing an annual account or report to the beneficiaries regarding the activities of the trust. And here I would gather to say that providing just information about a cash account set up for the trust is not sufficient to provide proper notice unless you're disclosing also information regarding the life insurance policy, whether it would be an outside annual review or at least an annual statement provided by the insurer, the insurance issuer on the policy's performance. I'm next going to flip to and spend just a couple of minutes talking about what I refer to as the duty of loyalty and the duty of impartiality. And this is another very important responsibility and obligation of a trustee. And where we see this implicated as it relates to ILIT specifically relate to transactions between the trust and the grantor/insured. And then I would also say future transactions between the trust and the insured's estate. So I'm going to touch on both of those briefly and then turn it over to Aaron. So as it relates to transaction between the trust and the grantor, it is not uncommon. I regularly engaged in these transactions for my clients where there might be an existing irrevocable trust or an ILIT specifically, and it wasn't funded with all of the life insurance that a grantor insured owned. And at some point, the grantor says, hey, I really feel like we need to get this out of my estate. Can we transfer this insurance policy to a new ILIT or an existing ILIT or existing irrevocable trust? And the answer is yes, you can. You can gift it, but that triggers what's referred to as a 3-year inclusion rule. So a gratuitous transfer of a life insurance policy to an irrevocable trust or to anyone would be included in the death benefits would be included back in the grantor's estate if they die within 3 years of that gratuitous transfer. So often these transfers are structured as a sale and purchase. So grantor insured sells the policy to the trust. The things to consider there are, A, is that a prudent decision by the trustee to make to buy that policy? 2, determining how is it valued? Are you over or under paying for it? Should you rely just on value provided on a Form 712, or are there other things to consider that make that policy more or less valuable than what's reported on a Form 712? And then I would say the other bucket of issues that I saw in my private practice come up quite often and would caution folks who draft ILITs to really consider is, remember that the reason why insureds, insurance advisors, and estate planners use ILITs is to get the death benefit proceeds out of a grantor's estate to provide that liquidity back to the estate without paying estate taxes on it, so that the estate then ultimately has that liquidity for estate taxes. So there, it's really important to make sure that the provisions of the ILIT, the dispositive provisions, mirror those of the estate plan of the grantor insured. If there are different beneficiaries of the ILIT than there are of the estate, it begs the question, how can the trustee then either purchase assets from the grantor's estate or loan funds to the grantor's estate without diminishing or otherwise implicating the interests of the beneficiaries of the trust? You have to really weigh those. Why would a trustee take this slug of cash, I'll call it a slug of cash, that death benefit, and loan it to the grantor's estate, depriving the beneficiaries of that ILIT of immediate access to that cash, when the beneficiaries of the estate who need that to pay the estate taxes are different? So that is, just an issue I've seen happen before, and bring some caution to that. And with that, I'll turn it back over to Aaron.
I'm going to take a look at briefly just managing TOLI risk, and really start with looking at the 3 different risk types and what classifies each. And we'll do this before we jump into more life insurance. But with legal risk, what we're looking at here is really the potential for trustees, advisors, other fiduciaries facing or to face litigation, I should say, and legal liability stemming from that alleged breaches of fiduciary duty, especially when we're talking about TOLI management. And this can include a wide range of things, but I know Andrea just hit on it here, but we talk about improper policy selection. This gets into conflicts of interest, and then dives into inadequate monitoring or failure to monitor. So when we fail to act on underperforming policies, we get into the remediation aspect of things, and then the all too familiar lack of documentation of trustee decisions. And when we look at regulatory risk, it's really getting into that exposure to penalties, sanctions, enforcement actions due to that non-compliance with the evolving state insurance regulations there and trust laws and disclosure requirements. This includes adherence to the Uniform Prudential, or Uniform Prudent Investor Act, or UPIA, that you hear a lot about. Also includes state-specific trust codes and applicable regulatory guidance. And then when we get into the reputational risk, that's the potential damage to professional standing, which could include your client relationships, business prospects, resulting from that public perception of mismanagement. And that's regardless of the legal outcome. As we go through, especially when it gets into litigation or disputes, the goal is to avoid that altogether, to be proactive, because regardless of any legal outcome, it's going to be expensive and you're going to suffer that potential risk. In TOLI context, that includes client trust or loss of that trust, diminished referral networks, compromised credibility, and much else, following that publicized dispute. So when we look for guidance, as you can see there, the UPIA, it's often referred to, and when you look at the Section 9, getting into that delegation of investment and management functions. As we go to the next slide here, we're going to start to dive into more of the portfolio demographics. And we're looking at these just really interesting stats surrounding what we call the aging insured. And we're looking at real data here. It's something that we worked on from our ITM client portfolio analysis, from all the accounts and policies that we manage, really showing how the demographic landscape of insureds has transformed. And based on our research, we really see a significant shift in the age distribution over this last decade plus, notably in the 80 to 90 and 90 plus age brackets, which have experienced just unprecedented growth. People are living longer. With that comes a whole new set of challenges. And now this group, this pack of policies and insureds, represents nearly 25% of the portfolios that we manage, which is a pretty good indicator of what a portfolio looks like for a trustee. Now, this longevity trend really is just showing that substantial increase in these advanced age categories, while seeing a decrease in that younger segment over that 10-year period. And those complex challenges, for policy management can't be understated. We know life insurance costs increase with age. That's how policies are built. And when you look at the portfolios of policy, we know, off the bat, upwards of 34-35% of all policies are going to be considered high risk. And if you ask, what does high risk mean? In simple terms, that policy is projected to lapse within the next 10 years, which is putting at risk the whole purpose of this trust, or this ILIT, and also losing all the premium dollars potentially that have been paid in. There's a lot of things that can happen in there, but the main thing is just ensuring that death benefit remains intact. And when you start to factor in, and we'll get into challenges here in a second, but when you factor in everything else, the outside circumstances that can complicate matters, you get into the health issues or health deterioration, family dynamics. Each trust has a different set. Premium cost, each product type has different elements. Everything, all these factors really significant can complicate those matters. So, Shandy, we'll get into that next slide here. Now we dive into the challenges, and we're focusing on the primary challenges and touching on them. There's a lot of things that are going on, so we're just going to spend some time looking at that policy performance, policy complexity within the different products, the increased expectations that are placed on you as trustee, and then we get into the litigation and disputes. Now, as I noted, we know that as the insureds get older, I touched on the issues around those policies generally increase as well. And the challenge starts when you really start to dive into the variations of the products. We'll touch on term, whole life, guaranteed universal, variable, index. We'll touch on the main characteristics of each. But then we also dive into, how are premiums being paid? Are they paid out of pocket with cash? Are there dividends? Are there policy loans? Is there a combination? And then we get into the different aspects of the policies. Is there a term rider? If so, is there a sudden decrease? Is there a no lapse guarantee? What's the allocation if it's a variable policy? These are all questions that need answered and understood and must be reviewed annually as a trustee. Now, when we dig in to the policy performance, this is really the culprit of a lot of issues that we deal with as trustee. And as noted, there's many things that can affect how a policy performs. But for this session, I just want to focus on more so the non-guaranteed elements. In this case, the chart we're looking at here is in relation to dividends, which you see with whole life policies. But the crediting rates on just current assumption or standard universal life policies follows a similar trend. And when we look at whole life policies and dividends, that dividend interest rate has been on a steady decline since it reached historic highs in the 80s. And as you can see by that chart, which goes through 2020, that's been the steady decline from then up to about 2020, where it's plateaued and even increased lately. But you can see on the chart, and you may ask, why is the Moody's AAA index on there? That Moody's AAA index is an important financial benchmark, really, that tracks the performance of AAA rated corporate bonds, and that many life insurance companies use as a reference point when they determine the investment component of their dividend scale. So it doesn't fluctuate quickly in terms of the dividend scale, but it has been, like I noted, a steady decline through the years. And with the underperforming dividends comes policies that are underperforming. And the same thing can be said with underperforming crediting rates, or declining crediting rates on universal. These policies have not lived up to how they were sold. And so when we talk about the current assumption universal life and crediting rates decrease, I'll walk through how the whole life may be affected, how the universal life may be affected. But in essence, it comes down to those lower rates during these low interest rates environments. So in these policy cases, we talk about what the issue is and what is the solution. So in short, if we're looking at a universal life policy, just a standard current assumption universal life, if we were looking when this policy was purchased, let's just say a policy that was purchased with $1 million death benefit, you had planned annual premiums of $10,000 when it was purchased back in, say, the mid-90s. That policy was projected to continue out to maturity age 100 of that insured. Now, fast forward 20, 25 years later, I know we heard the term, Andrew had mentioned, set it and forget it, which is a very common thing that we see. If that policy has not been reviewed each and every year as it should, you may be in for a rude awakening. And we see too often where the client says, hey, I thought this policy was essentially paid up, or I just pay this premium and it's good till age 100 or beyond. The reality is now that policy may be looking like it's going to, say, age 85. You say, well, where'd the 15 years go? Well, declining crediting rates. There could have been increased non-guaranteed costs in that policy or the COIs. There's a lot of things that could happen. Maybe they skipped a premium. Maybe the advisor said, hey, you've got cash value. It's a flexible product. You don't need to pay it. There's so many things that happen over those 20, 25 years that it's not hard to see why it's now, once you fully understand it, why it's only projected to say age 85. And when we start to look at the options available to extend that duration or to fix that policy, the first solution is you got to dump more premium into that policy. Is that the best solution? Maybe, maybe not. That is solution number one. There's other options, including reducing the death benefit or a combination of increasing premiums and reducing death benefit. You get into it may be possible to replace the policy. But in many situations, if that insured's too old, maybe their health's deteriorated, that replacement or getting out of that policy may not be feasible. So we start to look at all the options. There could life settlement could be an option. And last case, maybe it's a surrender. So all options are reviewed and discussed there with the client. And the main thing is communication and getting everybody on the same page. Now, if we look at in similar fashion, how does that whole life policy run in that same scenario with the declining dividend scales? In many cases, if we look, say, back to 2000, where you can see that dividend rate's around 8%, and maybe it was projected that after 10 years, dividends, and keep in mind, that's assuming that, when these policies are sold and that illustration's reviewed by the agent and the insured, it's assuming that same dividend scale year over year. It's not assuming a decrease the next year and a decrease the following year. So when they're purchasing that policy in 2000 at 8% dividend scale, it may be that the dividend's projected to be sufficient in 10 years to pay that premium. But what happens? 20 years later, they're still paying premiums out of pocket. Now they're starting to get irritated. Why am I still paying a premium? I was sold that this thing would be paid up after 10 years. It's like, well, we will point directly to that dividend scale, and we can chart that and look how that has performed over the years. The other flip side of that is maybe they stopped paying after 10 years, thinking that the policy was paid up, and if nobody was watching, now all of a sudden policy loans have been kicking in to pay that premium. So there's a lot of things that can happen there, but it's definitely a stress in policy funding when we talk about these decreased scales and decreased crediting rates. Now the question comes up, will it change? Go to the next slide there, Shandy. And it's a great question. It's a common question. Will the dividend scales increase? Will the crediting rates increase? These are influenced by several factors, not to get into, but the good news is we have seen several major insurers increase the rates. We're seeing an increase in the dividend scale rate. We're seeing non-guaranteed crediting rates, higher than they initially were. Now, at the flip side there, I would say a lot of the current assumption ULs that have decreased over the years down to the guaranteed minimum, which may be 3 or 4%, have not seen that increase. But time will tell. And now we're going to dive into more of the permanent policies and the complexities that we face. Now, I went through whole life policies and just current assumption ULs. I'm going to touch briefly on term, but more focus on the complex permanent. When we talk about term insurance, we see enough of it in the portfolios that we know that 15-20% of policies may end up being term in our blocks. But term insurance is the most simple to understand. It's also generally the most cheap, low cost policy. A majority of the ones we see are a 20 or 10 or a 20-year level period. In short, premiums are level for that period, but they do increase after that period expires. So you pay a premium, you have a guaranteed death benefit. There's not a lot of bells and whistles. There may be riders that are in that. There may be a conversion option that's available. But the most important thing to note, there's no cash value. That premium drives the policy. That premium cannot be late or at least past that 30-day grace period. If it is, that policy lapses. Now, there may be options to reinstate, but there needs to be diligent management of term policies as it comes to premiums, especially if they're on a monthly, which I advise against, but quarterly, semi-annual, annual would be preferred, because the more often you're paying premiums, the more at risk you are that maybe a premium doesn't get applied to the correct policy or doesn't reach the carrier. So it's important to monitor that. Now, when we look at the permanent problem or policies here and the products in a historical continuum, we look at the whole life policy, which I talked about. This policy is kind of a flagship, the old school. It's the guaranteed death benefit. You have non-guaranteed dividends. It's designed to endow. Now, it's also the most costliest of when we look at the permanent coverage options, but it is relatively easy to understand. The most often aspect of it that's misunderstood is if there's a rider, is there a term rider? And in many cases, if there is a term rider, it may be providing a considerable portion of that total death benefit. So it's important to keep an eye on that, making sure that it's flagged and understood, because any changes to that dividend scale, especially decreases, or worse yet, is if you decide or the client decides, I want to change my dividend option on a policy like that to pay a premium, that could result in a substantial decrease to that death benefit if that term rider is terminated. But when we move on from whole life and then we get into the variations of universal life, I talked about the current assumption or the non-guaranteed. The beauty of that product really is the transparency. It's fairly easy to understand. If you understand an Excel spreadsheet or how to work a spreadsheet, you're going to understand, or you'll be able to figure out what's going on in a universal life. Premiums, they're paid into the policy. They grow tax deferred in that policy based on that crediting rate. And each month the deduction comes out to cover those costs, those expenses, which is generally the COI being the largest of those deductions. But as we move down the line, we get into the guarantee and the variable and the index, the complexity starts to increase. When we talk about the guarantees and that guaranteed product, it really came on the scene as a new generational type of product with that no lapse guarantee. That removes essentially the market risk. Now, while there's flexibility, it's a universal life, you can change up how premiums are being paid. You really have to be aware on how that late premium or that skip premium affects that policy. And the changes for these guaranteed products vary from product to carrier to carrier. One could be very sensitive to a late premium while the next one may not be. So how do you know? You have to dig in. You have to have somebody in there that can take a look at the policy and really look at it. And when we get down into the variable universal policy, we start to look at flexibility with the premiums, sure, but this is also the first policy that you could lose money depending on those investments inside those sub-accounts. So you need to be aware that the owner really is in charge of how those premiums and cash value is allocated. Upside, high returns equals less premiums that are needed. Downside, poor performance means more premiums are going to have to be paid in. And when we get into the newest of the product, the equity index, this product is really just designed to capture that high return or the higher returns than the traditional ULs could obtain with a downside protection. It's marketed as more conservative than traditional variable policies that can have negative returns, but based on the new policies that we see, this one also is the most misunderstood, and at the same time, a majority of the new policies that we see. So it's an interesting mix there. And when we get into how this policy is misunderstood, it really stems around the performance and the costs inside that policy. There's a cap rate that's non-guaranteed that can fluctuate. Insurance companies can adjust or lower. But like I mentioned, issues that we really see around these index products are, I would deem, the illustration risk. It's meaning that projected performance may have been overly optimistic. These products also, like I mentioned, have higher internal costs. So it really needs to be understood when you dig into these policies on how they are going to perform and how they're going to be projected to perform. Go to the next slide there. So when we talk about, what's the solution? What's the process in place? What does this entail? I'm going to try to keep this as simple as I can. With these 6 core principles that you see here is understanding the policy. It's easier said than done. Life insurance, it's simple in some situations, very complex in others, but you need to develop and have a comprehensive knowledge base of all the policies, the details, the mechanics, pulling out contractual provisions. We're not even getting into what happens at maturity during this session, but understanding what happens at maturity. What is the age of maturity? Is it 95? Is it 100? Is it 130? Like you see, often misunderstood. And then it comes down to who's on your front lines. Who are your mechanics, so to speak, or your policy experts when it comes to life insurance management, so that you can rely on. Is it in-house? Is it a hired party, unbiased, independent? Who do you have there to understand? And we get into memorializing those expectations and outcomes. Documentation is key. We get into a lot of documentation. There's a lot of issues that can stem around lack of documentation. It needs to be clear. Trying to keep these documents simple and documenting for the trust file, what exactly is happening. Hey, here's your premium that you're paying. Here's your projected duration. You understand this. We're documenting the file. These are the potential solutions or options. That can be reviewed systematically each year, every 5 years, depending on what the policy situation is. But the reviewing of the annual reviews, those systematic yearly evaluations of a policy performance, one of the most common causes of issues is not having that review done annually. If a policy is on a set it and forget it, or nothing's been done for the last 10 years, I have no idea what is in that trust. Could be multiple policies, could be multiple ticking time bomb. You really need to know with that annual review to catch any changes as well, from year to year, and looking ahead and anticipating. That stems right into the communication. When we talk about remediation a little bit, the goal is proactive, being as proactive as we can, looking ahead and anticipating issues or seeing the issues. And the one thing we say, it's a lot easier to fix a policy now than it is 20 years down the road. Communication, I can't stress that enough. Communication, it's that consistent dialogue that you need with the client and any stakeholders, and that includes the bennies. You have the best contact info. A lot of times when we get a new set of trusts on our system, a lot of the information may be stale. That phone number may not be good. That email may not be good. Doing your due diligence to confirm all the information is accurate so that you have no issues following up when you need to, and then adjusting to those changing situations. And that really stems to being proactive and staying in contact with the insured. One of the things that we see missed often is changes in the insured's health. You want them to feel comfortable that they can reach out to you if they have a substantial change, because they should understand, depending on how they're funding a policy, if I'm the insured and I've got that policy funded for it's good for the next 40 years, but I have a sudden diagnosis of a terminal illness, I need to understand that, and that, there's going to be options that may save that trust and myself like premium dollars there. When we get into the next slide here on increased expectations, best interest standards, we talk about the heightened fiduciary requirements. That really places that client welfare above everything else. And when we talk about these standards, you get into loyalty, prudence, impartiality, documentation. The main thing that the trust beneficiaries are your main client. Anytime a policy is at risk, those trust beneficiaries need to be aware. They need to be included in that communication, especially when it starts to look at options. And when we talk about advisors being held to a higher standard, that trend of imposing stricter professional accountability on TOLI advisors is there, and it's increasing. And we talk about growing consumer awareness, beneficiary awareness. There's so much out there now. There's so much access to information. We just see an increasing sophistication of those grantors and beneficiaries regarding life insurance and options. They can punch us into Chat GPT or AI, and it'll spit out a lot of information, especially when you get into litigation, which we talk about briefly on the next slide. But the main thing is there's awareness. 20 years ago, maybe not so much, especially when we talk about beneficiaries, but it's a new wave of what these beneficiaries are understanding. So it's important to be educated and then to keep them in the loop there. And we would talk about litigation and disputes. Lastly, for my section here, we do have several notable cases. I'm not going to dive into those, Cochran versus KeyBank or Parity versus Parity. The one thing I want you to know is what is the most common claim. I touched on it before. It's the failure to monitor on a systematic basis the policy performance and issues going on. From that, you'll have, documentation could be a potential issue. Missed premium payments are a potential issue, but just failure to act, not doing anything. The head in the sand mentality, we see it too often, is monitor, monitor, monitor. You need to understand. And when we get into the TOLI disputes that do not reach the courts, while the non-litigation and in most cases do not go to litigation, they're settled out of court. Is that better? It's still very costly, and like the main goal is to avoid it altogether, right? It's to avoid any disputes, any litigation, any issues, and part of the solution to that is to be proactive. Advisors always at risk there. We talk about types of advisors being at risk, potentially RIAs or broker dealers, and then we get into the carriers and the lawsuits there. But we have a lot of issues going on. But I'm going to hand this over to Andrea here, and I know we're pushing the end of our session. So.
Thanks, Aaron. So I think Aaron did an amazing job expounding on the outset discussion about trustee duties and responsibilities and really applying it to the complexities associated with TOLI. And, the reason why I started talking about the duties and responsibilities of trustee before talking about trustee selection is just that I think sometimes people put the cart before the horse. They select a trustee before they understand what it means to be a trustee, in particular a trustee owning a life insurance policy. And so with the background of everything that Aaron and I have touched on, which doesn't include an in-depth conversation about everything associated with TOLI and ILITs, let's spend a little time talking about what goes into that decision making of who should be a trustee and what your trustee options are. So Shandy, if you could just advance to the next slide. There's really three general buckets of types of trustees that an individual can consider naming for any type of irrevocable trust. The first is an individual non-professional trustee. This is usually a family member or a trusted friend. They typically don't have any background or experience at all in serving as a trustee or managing any specific assets. And they probably don't fully understand and appreciate the role and responsibilities of being a trustee. This is, typically what I would see, and this is Aaron touched on a little bit in his talk here today, is I couldn't tell you how many times as a trust and estates attorney I would have an insurance advisor bring a client to me and say, hey, we need to set up an ILIT, but they're just going to name their brother, their sister-in-law, or whoever, somebody as trustee, because really all that trustee needs to do is write a check every year. I would say, rather say that I hope at this point in our presentation you realize that is not the case. There's a lot more that goes into it. Sometimes when you'd have this conversation about what goes into it, a client would say something like, well, I'm going to name my CPA says they'll do it, or my fraternity brother or sister, sorority sister is a lawyer and they say they'll do it. I would say that unless you're a trust and estates attorney, I don't know that you fully understand what it means to be a trustee. I would also say, even if you are a trust and estates attorney, if you're an attorney or you're a CPA, and you're, an active professional, you don't have a lot of free time. You don't have a lot of time to dedicate to all of these responsibilities. And so looking at time capacity, even relative to, Aaron, if you could mute, thank you. That'd be great. I think can be an issue, a significant consideration. And so what I started to warn clients about is, hey, listen, there's a lot that goes on here. And a lot can happen over the life cycle of a life insurance policy. A premium payment can get missed is, one. But there's also just monitoring the policy. And if the policy doesn't perform and it is not caught in time, that policy risks a lapse. And I think the last thing any insured wants is for their family, who are the ultimate beneficiaries of the value of this policy, to have to sue Uncle Joe or Aunt Jane or whomever in their familial circle who, oops, didn't do what they needed to do. So then that pivots to really the corporate trustee option. And if you go to the next slide, Shandy, we just got a couple minutes left. What has happened here is that a significant number of corporate trustees have exited the ILIT market. And the reason is a combination of the risk factors related to trusted ILIT administration and the complexity of ILIT administration, and some litigation in that area, coupled with the significant pressures that clients and sometimes insurance advisors put on providers in this space to say, hey, this client shouldn't have to pay more than $1,500 a year for you to administer this ILIT. And the reality is that's not going to cover the cost to do it and do it right. So if anything, I like to use this discussion that I've had on ILITs several times throughout the course of this year to try to educate the advisors and professionals in this space to help bring transparency and awareness to their clients so that you understand that this is a very valuable and important asset for your client. And mismanagement will cost way more than an appropriate trustee fee. And so understanding why the market prices ILITs the way it does for those who provide the service is going to be key in educating the consumer base. And so I think that's the best talking point I can give here to advocate for that awareness so that clients have better options. They have more corporate options to protect and preserve policies that are held in ILITs. And with that, I think we've got just a couple minutes left. If there are any questions.
I did have one question that came through here was
Okay.
how the annual reviews are completed or the timing and
Mm-hmm.
for our internal process, we time those reviews around the anniversary of the policy, if at all
Yep.
possible. If there's multiple policies, it may be towards the end of the year or the last policy anniversary, but there should be, there's not a right or a wrong necessarily. It's just there has to be some kind of systematic process for, having those reviews completed.
Yeah, Aaron, and I agree 100%. Working at corporate fiduciaries, what we would typically do is have those performed right around the policy anniversary. They're great reviews because not only do they evaluate the policy performance, they evaluate the policy carrier. They give a grade on the policy carrier, so it gives you some information there as the trust owning the policy. They run some projections based on current policy performance. If there's a risk of lapse without an increase in premium payments or an increase in policy performance, when that is projected, give it an actual numerical grade like you're back in school. Is it an A? Is it a B? Is it a C? Is it an E, an F, etc.? So it's really easy to follow.
Great. All right. I know we're right at the end of our time, but again, thank you, Andrea, for joining TrustEd University on this today's session, and I appreciate everybody taking time to join us today. And if you have any questions after this is done, or if maybe tomorrow you think of something, definitely reach out. Happy to talk more with you there.
Thank you.
Okay.